Let's work on a treasury stock example problem. Sterling Company purchased from its stockholders 4,000 shares of its own previously issued stock for $120,000. It later resold 1,500 shares for $35 per share, then 2,000 for $31 per share, and finally 500 shares for $10 per share. We need to take that information and prepare the journal entries for the purchase and the 3 sales of the treasury stock. So let's first work on the purchase of the treasury stock. So we purchased 4,000 shares for $120,000. What are we getting? We are getting treasury stock, right? Whenever we buy back stock from our shareholders, that's called treasury stock. So we want to debit our treasury stock, and we are using cash to purchase this treasury stock, so we credit our cash. And for how much? That's where that $120,000 comes in. Now, we resold 1,500 shares for $35 per share. So we will be getting money, right? So we want to debit our cash. And we're selling some of this treasury stock, so we want to credit our treasury stock. So let's figure out the numbers that we're going to use here for cash and treasury stock. First, for cash, it's your 1,500 shares times the $35 per share price. So we will debit our cash, $52,500. Now for treasury stock, we want to figure out what we initially bought back these shares for. So when we first bought back these shares, we paid $120,000 for 4,000 shares. If we divide those two, we see that we paid $30 per share. So we'll be using that $30 per share amount throughout these journal entries. So here, we sold 1,500 shares. So we take the 1,500 times the $30 that we just calculated, and we will credit our treasury stock for $45,000. Now, our debits and credits don't equal, right? That's because we sold these shares at a different price than what we initially bought them back for. So that's when we will have to include our paid-in capital from treasury stock. Now, there's a few different ways that you can figure out your paid-in capital from treasury stock amount here, right? We know that our debits and credits have to equal. So we could just do 52,500 minus 45,000. But let's talk about where that number is truly coming from. So your paid-in capital from treasury stock will be your 1,500 shares times the difference between your cash per share amount and your treasury stock per share amount. So 1,500 times 5 equals 7,500. So we will credit our paid-in capital from treasury stock for 7,500. Now we are selling 2,000 shares for $31 per share. We are still getting cash, so we still want to debit our cash, and we're still selling treasury stock, so we will credit our treasury stock. We figure out our cash amount by taking our number of shares times the price per share that we're selling these. So 2,000 times 31 gives us that 62,000. Treasury stock, we're still working off of that $30 per share amount. So 2,000 times 30 gives us 60,000. Again, we need our paid-in capital from treasury stock. So we take 2,000 times 31 minus 30, our cash per share amount minus our treasury stock per share amount. And we see that we need to credit our paid-in capital from treasury stock for 2,000. Now, before we go any further, let's make a T account for our paid-in capital from treasury stock. So, in our first entry, we credited our paid-in capital from treasury stock, 7,500. In this entry, we credited 2,000. So right now we have a credit balance of 9,500 in our paid-in capital from treasury stock. And that's going to come into play here in the last journal entry. Here, when we sell 500 shares for $10 per share. So we see that we're going to be getting cash because we're selling treasury stock. So we debit our cash and we credit our treasury stock. How much are we going to debit cash for? Well, your 500 shares times $10 per share gets us that 5,000. So we'll debit our cash for 5,000. Treasury stock. It's still working off of that $30 per share amount that we calculated earlier. So 500 shares times $30 per share, and we credit our treasury stock for 15,000. Now, our debits and credits don't equal. We need to add more over on the debit side this time. So we will debit our paid-in capital from treasury stock. And in a perfect world, we would debit our paid-in capital from treasury stock for 10,000, and we could just move on with our day. But if we take a look at that T account over in the lower right corner, you can see that we only have 9,500 in that account. So in your paid-in capital from treasury stock account, you can only have a credit balance or a zero balance, meaning that the most that you can debit in this scenario is 9,500. So that's what we're going to do here. We're going to debit 9,500 for our paid-in capital from treasury stock. That's going to take that account's balance all the way down to zero. So we don't have any more that we can debit our paid-in capital from treasury stock. But we still have this extra 500 because we need an extra 500 over on the debit side to make our debits and credits equal. And where does that come from? That will be taken out of your retained earnings.